This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Far and wide, the record rally is reaching just about every corner of the market. So what should you do with your money now?
Losses mount. Sears, once America's top retailer, sees its sales spiral. And as more stores close, the challenges are only getting tougher.
30 years of picking stocks. So what are the Beardstown ladies investing in now? We went for a visit. Those stories and more tonight on Nightly Business Report for Thursday, December 8th.
Good evening, everybody, and welcome. 4 indexes, 4 new highs. The Dow, the Nasdaq, the S&P, and the small cap Russell all closing at record levels. After a quiet morning, momentum picked up midday thanks to gains in financials and basic material stocks. Investors had been buying stocks since Election Day, betting that the new administration's policies would support growth and inflation. Today, the Dow added 65 points to 19,614. The Nasdaq advanced 23, and the S&P 500 was up 4. One of the hottest groups since the election has been the transportation sector. And tonight, Morgan Brennan explains why.
Transports keep on trucking. Driving the surge are prospects for stronger economic growth, infrastructure spending, and corporate tax reform, which investors seem to believe outweigh the risks of more protectionist trade policies. But it isn't just about the election. The Dow Jones Transportation Average has rebounded more than 40% off its January lows, when economists were warning of recession, and for the year is poised to gain 25%. The biggest winners, trucking names including Landstar Ryder and J.B. Hunt, and rail stocks like CSX and Union Pacific. Many of them are companies with big exposure to industrial production, mining and manufacturing, which has shown signs of stabilization in recent months.
I think there's some of the gains that have been pulled forward. So this group, particularly the domestic group, benefits a lot from tax reform. So I think that has the potential to drive significant earnings power as well as free cash generation. But I also do think that we are coming off of a bit of a bottom from a freight perspective. So we have seen a bit of a rally here in the late summer through the fall. And so volumes are up a bit. So there's a fundamental underpinning of this as well.
After a year-and-a-half-long freight recession, volumes are beginning to grow. A closely watched index ticked higher for the first time in 20 months in October, with domestic freight shipments climbing nearly 3% compared to last year, and a reading considered better than the normal seasonal surge. Though still well off their peaks, data readings from hard-hit rail and trucking companies are showing early signs of recovery as well. And at least one analyst says soaring air freight tonnage is a clear signal that consumers are ramping up spending. It's all fueling a transport rally. But one experts warn comes with risks, including higher oil prices, rising interest rates, and the trade impact of a strong dollar. For Nightly Business Report, I'm Morgan Brennan.
Let's look at how far the market has climbed. In the past month, the Dow is up 7%. The small cap Russell 2000 index has soared 15%. Now, those are big moves by any measure. But look at the market's performance since the lows of February. The Dow is up 25%, Nasdaq 27%, the S&P 500 23%, the small cap Russell index a sharp 44%. Timing, folks. It's all about timing.
Speaking of which, what should you be doing with your money at this time? Let's get some answers from Brian Jacobson, Chief Portfolio Strategist at Wells Fargo Funds. Brian, nice to have you here. Welcome.
Thanks for having me.
If I'm sitting at home and I have not committed new money to this market at this point, is it too late, or do I just have to be very selective and continue putting money in?
Yeah, it's unfortunate. I do talk to a lot of people who seem like they've been sitting on the sidelines. It seems like there's almost a risk gauntlet that people have been running through. You know, you kind of get hit on every side, whether it's Brexit or it's China's currency devaluation, the presidential elections. But we've made it through each one of these. And I think that's kind of a key message is the market is pretty adaptive. A lot of times you have to ask yourself what's priced into the markets. And right now, I think that actually we've just had a general repricing or reflation of assets to pretty reasonable levels. From a valuation perspective, I don't think that anything really worries me all that much in the near term or even for the long term. So the key thing, I think, is to focus on the long term and actually try to get your portfolio back in line with your long-term investment objectives. That's a hard thing to do because everybody wants to try to time the market. But the fact is, sometimes you just have to bite the bullet and do it.
What do I do, Brian, with my bonds if I've been investing in bond funds, as so many Americans have over the past half decade or so, and now they're going to look at their statements and they're going to see some down months? What should I do?
Yeah, they are going to see some down months, but put those down months into perspective as far as the magnitude. Oftentimes, the drawdown in bonds is significantly smaller than the drawdown that you get in stocks, because stocks are inherently riskier than fixed income investments. And so remember the role that the bonds play in your portfolio. They are there to diversify away some of the risks that are inherent in the stock market. And they've actually done a pretty good job of that. As the equity market has gone up, bonds, unfortunately, the prices have gone down. That's the problem with diversification. Sometimes it works against you. But having it as a central part of your portfolio to diversify, add some stability, and generate income. What I've been really looking at and encouraging people to consider is looking at shorter duration strategies, short-term, especially high-yield bonds. Those are the ones that some people call them junk bonds. I want to speak highly of them, so I'm not going to call them junk bonds. I want to call them high yield. So you're paid to take a little bit of that credit risk, and that can hopefully offset any decline in price as a result of an increase in rates.
All right, Brian, thank you. Brian Jacobson with Wells Fargo Funds.
Well, one popular investment strategy that gets a lot of attention at the end of the year is the so-called dogs of the Dow. Those are the 10 stocks in the Dow with the highest yields. And if you bought shares in these bow wows at the start of 2016, you're probably pretty happy right about now. Dominic Chu explains.
This is the time of year when many investors start looking at the dogs of the Dow investing strategy. Now, basically what this is looking at the 30 stocks in the Dow Jones Industrial Average, picking out the 10 stocks that have the highest dividend yield, buying those stocks in equal dollar amounts, holding them for a year, and then redoing the same thing again the next year. Now, the strategy doesn't always outperform, but it has in a big way this year. And the idea is to really get investors to focus on perhaps beaten down names in the Dow and the ones that give bigger dividend payments. If you look at the list this year, it's an interesting one, and we have some real gainers, the ones that really propelled the Dow Jones Industrial Average and, of course, the dogs of the Dow to be outperformers. If you look at the biggest gainer so far in this dog strategy, it's construction equipment maker Caterpillar, one of the most beaten up stocks in the Dow last year, now up huge. If you factor in dividends, it's up 49%. Oil and gas, big laggard last year. Oil prices have recovered. Chevron up 32% if you factor in the dividend payment as well. IBM, another laggard last year and has been for a few years now, but Big Blue is now up 24% this year if you factor in those dividend payments. And then Walmart and Merck kind of round out some of the biggest gainers in the dogs. Now, what about next year? As it stands right now, you take a look at some of these: Verizon, Pfizer, Chevron, Cisco, IBM, Exxon, Coca-Cola, Caterpillar, Procter & Gamble, and Merck. These are your 10 highest yielding stocks if the Dow and the dogs were named right now before the end of the year. If you take a look overall, check out these, because according to analysts, these are the ones that have the biggest percentage to gain. Pfizer, Merck, Coke, Caterpillar, and IBM, because of their big gains now, perhaps laggards. So as we talk about the dogs, keep in mind those stocks and the analyst outlooks for next year. For Nightly Business Report, I'm Dominic Chu.
Are you feeling richer? Well, maybe you should be, because household wealth in the United States has hit a record. According to the Federal Reserve, a buildup of both real estate and stocks helped drive American wealth to more than $90 trillion in the third quarter, and the number is likely even higher now since the market has rallied over the past month.
The outgoing chair of the Securities and Exchange Commission warns against rolling back Wall Street reforms. Mary Jo White said the rules implemented following the financial crisis are indispensable to investors and to markets. And in her view, it would be a grave mistake to weaken or dismantle them.
The House of Representatives passed legislation that averts a government shutdown. The measure provides funding for government agencies. It now goes to the Senate for passage. A provision in the bill will make it easier for Donald Trump to win confirmation of General James Mattis to be Defense Secretary. The former Marine needs a special exemption that lets him skirt a requirement that ex-military officials need to be out of the service 7 years before becoming the Pentagon chief.
There are also reports that Donald Trump has chosen a fast food executive to be his Secretary of Labor. Andy Puzder is the CEO of CKE Restaurants, which owns the burger chains Carl's Jr. and Hardee's. John Harwood is following the developments from Trump Tower in New York City. Good to see you as always, John. So what do we know about where Mr. Puzder stands on some of those labor issues?
Well, first of all, Sue, just before we came on air, it was officially announced that Andy Puzder will be the labor secretary choice of Donald Trump. What we know is that he is a longtime Republican, staunch foe of regulation, somebody who has, he backed Mitt Romney in 2012, and he expressed on CNBC earlier this year the view that the accelerating cost of labor is going to increasingly push businesses to reduce labor and use robots instead. Take a listen.
The working class needs a period of transition. We need to be able to train them. We need to be able to set people up for better jobs. We need to revamp the education system so people actually are qualified to do the jobs that exist. What's happening now is the cost of labor is accelerating at such a pace that it really moves up how fast you want to automate.
Now, in a different interview, Andy Puzder indicated that the attraction of those robots and automated devices is they don't take sick days, they don't have slips and falls, they don't need vacations. All of that is part of the broader trend in the American workforce. And of course, the question is going to be for Donald Trump is, as a candidate who is run as a populist to help workers, are he and Andy Puzder going to do that?
You know, John, the former Ford CEO did a marvelous job there. Alan Mulally also apparently scheduled to meet with the president-elect today. Do we know why and what he might be talking about?
It's a little unclear. Some reports have Alan Mulally as a candidate for Secretary of State, others for United States Trade Representative. We didn't get any confirmation on that from Donald Trump's aides today. But clearly he's looking to corporate America as somebody who brings a business resume into the Oval Office. He's looking to two really unusual sources or unusually robust sources of potential cabinet members, both the military, the Marine generals like James Mattis that you mentioned, but also corporate America.
All right, John, we'll let you go. Thank you so much. John Harwood at Trump Tower in New York City.
And still ahead, Sears slump, sales plummet, and the problems deepen at this one-time titan of American retail.
It was an iconic American retailer, but Sears lost its way, and things are not getting any better. The losses continue to mount, and today the company said there is no guarantee as to when it will return to profitability. It started in the 1880s when Richard Warren Sears began selling watches. It quickly added appliances, groceries, sporting goods, even automobiles to a booming and really ubiquitous mail-order catalog business. It was essentially Amazon for early 20th century America, becoming the country's largest retailer until Walmart claimed the top spot in 1989. Sears owns iconic brands, Craftsman for power tools, Die Hard products for your car, and Kenmore home appliances. At one time, it would have been silly to ask a passerby whether they shopped at Sears. Now,
I used to go more for appliances, but not as much anymore.
We just kind of don't really shop there.
So many other options. I mean, you have Kohl's, we have other promotions.
And then the other thing is I do a lot of shopping online.
In 2005, Sears was bought by Kmart, and hedge funder Eddie Lampert took over the new Sears Holdings. But that company has been on a downward spiral. Sales dropping from about $41 billion in 2012 to an estimated $24 billion this year. The stock price is down too, more than 40% this year, and down more than 70% in 3 years.
Sears Holdings is like the mythical headless horseman, wandering aimlessly in the night looking for its lost, never to be found head.
The number of stores, now about 1,500, is less than half what it was 10 years ago. At one time, Sears anchored many malls, but now, when its stores close, malls are often left with dead space, putting the malls themselves and many jobs at risk.
Sears has probably hived off well over 100,000 jobs since Lampert took over.
There is value in Sears stock, it might be able to sell the real estate that it owns, more than 160 million square feet of retail space, and its iconic brands, the Kenmores and the Craftsmans, are now sold in a lot of places. But with only 2 profitable quarters in 4 years, Sears will likely struggle to get top value selling its assets.
The Sears physical footprint shrunk, and because the sales of these brands have been diminished, in order for it to be worth a considerable amount of money, they need time.
But the irony is, Sears, an American icon that started out selling watches, could be on the clock. Shares of Sears may have been higher today, but over the past 5 years, they are down 70%.
Last year, we reported on a company called Insys Therapeutics. It was being investigated in at least 6 states. The allegations range from healthcare fraud to off-label marketing and kickbacks for its main drug, Subsys. That's a highly addictive opioid, fentanyl spray, basically, that the FDA says should only be used for cancer patients with severe pain. Today, we learned that several Insys executives and managers, including the former CEO Michael Babich, have been arrested, charged with leading a nationwide conspiracy to bribe medical practitioners. Nina Gosofsky, who first reported on that story for us, is here tonight. Why were they charged? What were they charged with?
So the reason that we're talking about former executives was because we have sort of seen this exodus of high-level employees from Insys ever since we reported on that story a year ago, including the former CEO, Michael Babich, after which billionaire founder of Insys, Dr. John Kapoor, took over. Now, my sources say that it was really John Kapoor who sort of orchestrated all of these alleged schemes that we heard in the complaint, everything from healthcare fraud to kickback schemes, trying to persuade doctors to not only write prescriptions of this highly addictive opioid for patients who did not have cancer, which is against FDA rules, but also to keep upping that dosage so that they get more reimbursement from the insurers. And so it's interesting that Dr. Kapoor was not named today, but I do want to mention that I spoke with the U.S. Attorney's Office in Massachusetts who filed the complaint, and they told me that this is still an ongoing investigation. The matter is still not closed, so it's going to be very interesting to see what happens.
And so is there proof that he did what your reporting suggests he did?
John Kapoor has not been named yet. Now, in terms of Michael Babich, yes, most of the things that we reported on. These are allegations. He has been arrested and he's been charged, but obviously he's going to, you know, like everybody else, have a fair trial. But it's also interesting because there were so many different government agencies that had to come together for this, including the FBI, the Department of Veterans Affairs, the Department of Health and Human Services. Insys, I did reach out to the company. They did not respond to my request for comment.
Hopefully they will.
To be continued. Dina, thanks very much. Dina Gosofsky.
Well, investors like the way Tailored Brands looks, and that's where we begin tonight's market focus. The owner of Men's Warehouse turned a profit in the latest quarter, beating analyst estimates as well as revenue expectations. Tailored Brands also said it expects to see same-store sales improve at its Joseph A. Bank brand. Shares skyrocketed more than 39% to $26.44. Lululemon shares continued to soar today following the company's better-than-expected earnings and a $100 million share buyback program that we told you about last night. Following those upbeat results, several firms upgraded the yoga apparel maker's stock today. So Lululemon's shares rose 15% to $68.84. And Horizon Pharma said it was terminating a drug trial of a medication intended to treat a rare neuromuscular disease. The biotech company said the drug, which has already been FDA approved to treat other diseases, failed to present a statistically significant benefit over the placebo during testing. Shares plunged 22% to $15.03.
Express Scripts saw its shares fall after short seller Citron Research tweeted that the pharmacy benefit manager was the culprit behind drug price gouging. Citron also gave Express Scripts a $45 price target and suggested that President-elect Trump may target the company when he takes office. Express Scripts fell 6% on the day to $70.75. According to a report by the South China Morning Post, China will impose ATM withdrawal limits at casinos in Macau, which is the world's largest gambling market. Starting Saturday, account holders will only be allowed to take out about $600 US. Following the news, Wynn Resorts, MGM Resorts, Las Vegas Sands, and Melco Crown Entertainment were all sharply lower. Restoration Hardware beat street targets in its latest quarter, but the home furnishing company gave guidance for the holiday season that was sharply below estimates. Shares were punished after hours, initially falling more than 15% after they finished the regular session up more than 2% at $38.99.
Forget the North Pole. Warehouses are holding a growing number of holiday gifts as shoppers move online and retailers ship more goods than ever before. And that means big growth for the companies that own those properties, warehouse REITs. And now some call them a hidden buy for investors looking to cash in on the gains since Election Day. Diana Olick explains.
In Cranberry, New Jersey, developers are taking down this office building and planning to replace it with a warehouse. Demand for warehouses, especially close to major metropolitan areas, is skyrocketing. And so is the potential for real estate investment trusts, or REITs, that own these spaces.
In contrast to a lot of other commercial real estate sectors where you've seen a deceleration of tenant demand, in industrial, you've seen an acceleration due to e-commerce.
REIT stocks have lagged the rest of the booming stock market because investors tend to buy them when interest rates are low. REITs offer high yields in the form of big dividends. But investors then sell them when rates are rising, as they are now.
I think usually you see, in reaction to a rate increase, REITs falling, and then 6 months later they come right back because the better economy improves operations for REITs.
Mogadam is CEO of the largest industrial warehouse REIT in the nation, Prologis. E-commerce represents just 10% of its portfolio, but makes up nearly 1/3 of its current growth. Tenants include FedEx and Amazon. Prologis is developing the largest warehouse park in the nation, an hour outside San Francisco. The idea is to be as close as possible to major metros as e-retailers strive to deliver goods in hours rather than days.
What I call the last 30 or 50 mile business, where we're building large warehouses in major metro areas that cover the entire metro area for major e-commerce players.
Other warehouse players like DCT Industrial Trust have a similar strategy.
They've positioned their portfolio so that most of their portfolios are now located in very large metropolitan areas, which has seen a disproportionate increase in demand from e-commerce.
The stocks of warehouse REITs have fared better than other REIT sectors, and while they might look expensive, they're still selling at a discount to underlying values. The one wrench, however, trade. Warehouses rely on two things, trade and consumption. If trade sinks under the Trump administration, so too could the value of these REITs. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, the Beardstown ladies. They've been picking stocks for decades, and tonight they'll tell us what sectors they like as the market rallies. Remember the Beardstown ladies? Well, they're one of the best-known investment clubs. And after picking stocks for more than 30 years, Kate Rogers went to visit the group to see what they make of this market rally.
The Beardstown ladies have seen it all, from the stock market soaring in the 1980s to the housing collapse in 2008 and the recession that followed. Through it all, they've continued to meet once a month in Beardstown, Illinois, contributing a modest $25 each for what they call the 3 E's: education, enjoyment, and earnings.
We've been through a lot of ups and downs. We've seen the market go up and we've all smiled at the meetings. When it goes down, we don't get sad, we look for bargains. Right. It's a sale. It's like a discount sale in a department store.
It's like Black Friday. You're right. Let's go shopping.
After launching in 1983, the ladies rose to fame in the 1990s, but they fell out of the public eye after a mathematical error inflated their rate of return. They've kept at it, though, with 16 members who today range in age from their early 30s to late 80s and come from different walks of life. There's a retired hog farmer and a funeral homeowner in the mix.
75% of our members are descendants of the original club.
And we have every age decade represented in our club, which I think is awesome too.
That's called diversification of our portfolio.
The strategy has always been simple. Buy to hold and invest in things you know, but do your homework. Today, the portfolio has expanded to 17 companies and over $450,000.
Berkshire.
Yeah. Berkshire B.
Berkshire B.
Yeah. We can't afford the A.
Yeah. Thank you. We have Apple. We have Starbucks. Aflac.
Bed Bath & Beyond.
Johnson & Johnson. Worldwide Wolverine Shoe Company. You know, ladies love shoes.
Aside from investing in what they know, the ladies are also paying close attention to the election of Donald Trump and the market rally that's followed.
I was glad he was elected, and we watched that market go down one day and it came right back up. We're looking at stocks that perhaps are going to be helped by adding more to the military and defense stocks, and so this is the type of thing we're looking at to consider buying.
Since their return scandal, the ladies won't reveal how their portfolio is performing, but they believe they'll end the year in the green. Aside from that, they're not making any calls about 2017. You don't want to make any predictions?
No. If we did, we would not be sitting here. We'd be in Aruba on a beach.
For Nightly Business Report in Beardstown, Illinois, I'm Kate Rogers.
That's great for them.
Gotta love it. Gotta love it. They had a great, successful book back when. We remember them.
I remember covering them in the 80s.
Yeah.
I know you do too. All right, that's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll see you back here tomorrow night.